Stop whatever you're doing right now. Put down the sandwich. Yes, even if you just took a bite, spit it out if you have to. This is more important than your lunch. Tell your boss you'll be back in a few minutes. If you're driving, pull over. If you're in the shower, get out. Are we clear? Good. Before I show you the numbers, subscribe, tap the bell, and stay locked in. Not because I want support, but because this market is changing by the hour, and the people who hesitate are the people who get played. I'm about to tell you something that should make your blood boil. On Monday, January 12th, we watched silver break through $85 per ounce. We watched the Shanghai Futures Exchange trade at $93. We celebrated. We talked about the death of the arbitrage. We talked about how the paper market was collapsing and the physical market was taking over. We talked about how the system was breaking in real time. And then last night, while you were sleeping, while you were scrolling through TikTok, while you were binge watching a Netflix show you'll forget in 3 days, the empire struck back. The Chicago Mercantile Exchange, the CME, the entity that controls the comics futures market, the entity that sets the rules for paper silver trading, sent out a notice, a margin notice advisory. And in that notice, they announced that effective immediately, not next week, not next month, but today, they are changing the rules of the game. They are changing the entire margin system for silver futures. And they are doing it in a way that is specifically, surgically, precisely designed to crush retail traders, to force out the little guy, to liquidate small investors, and to protect the big banks who are short and losing billions. This is not a conspiracy theory. This is not speculation. This is documented. I have the numbers. I have the math. I have the historical precedent. And I'm going to walk you through exactly what they did, why they did it, and what it means for your money. But first, you need to understand something. What you're about to hear will sound unreal. It will sound like the kind of market manipulation people joke about but don't want to believe happens in real life. It will sound like a movie where villains control the system and rig the game. But it's real. It happened last night. It is happening right now as you watch this. And if you don't understand it, if you panic and sell just because you see a red candle, you could miss the biggest wealth transfer of your lifetime. So focus, stay calm, and let me show you how the game is rigged. Here's what happened. The CME sent out a margin notice on Monday, January 12th. The notice stated they are changing margin requirements for silver futures contracts. If you've never traded futures, here's the simple version. When you buy a futures contract, you don't pay the full value of the contract up front. You post a fraction of it as collateral. That fraction is called the margin. Think of it like a security deposit. You're not buying the whole house. You're posting a deposit that gives you control of the whole house. For example, one silver futures contract on the COMEX represents 5,000 ounces of silver. At $85 per ounce, that contract controls $425,000 worth of silver. But you don't need $425,000 to buy that contract. Under the old rules, you needed about 30 $500 as margin. That's the appeal of futures trading. You can control a large position with a relatively small amount of capital. With $30 $500 controlling a $425,000 contract, that's roughly 13 to 1 leverage. For every dollar you put down, you control about $13 worth of silver. This is how retail traders, people like you and me who don't have billions, can compete in markets dominated by institutions. We use leverage to punch above our weight, and the banks hate it. Because when retail traders use leverage to go long on silver, when we pile into the market and start demanding delivery, it threatens their short positions. It threatens the whole paper Ponzi scheme. It creates pressure right where they are most vulnerable. So what did the CME do? They changed the rules to reduce our leverage and force us out. Here is the specific change. Under the old system, the margin was a fixed dollar amount, $30 to $2,500 per contract. It did not matter if silver was at $50, $85, or $100, the margin stayed fixed. Under the new system, effective today, the margin is a percentage of the notional value, specifically 9%. What does that mean in plain English? It means the margin is no longer a flat number. It is now calculated as a slice of the total contract value. If silver is at $85, one contract is worth $425,000. 9% of that is $38,250, so your margin requirement just jumped from $30,500 to $38,250. That is an increase of $5,750 per contract. That's a 17.7% increase overnight, without warning, in the middle of a historic rally. And here's the sneaky part. With the percentage-based system, the margin keeps rising as the price rises. If silver goes to $100, the notional value becomes $500,000 and 9% becomes $45,000. So the higher silver goes, the more cash they demand from you, right when momentum is hottest. That is how you turn a rally into forced selling. Now you might be thinking, okay, they raised margin by about 18%. That's annoying, but it's not the end of the world. Wrong. Here's why this is devastating for retail traders. If you were already using maximum leverage, meaning you deployed most or all of your available capital across multiple contracts, you woke up to a margin call. A margin call is not a suggestion, it's a demand. Your broker tells you your account no longer meets the required collateral. You have two options. Option 1, deposit more cash immediately to meet the new requirement. Option 2, close your position, sell, and get out. Notice what they've done. They didn't debate your thesis. They didn't disprove the shortage. They didn't fix the vault problem. They simply changed the entrance fee in the middle of the ride so you fall off. Most retail traders do not have an extra $50,000 or $100,000 sitting around ready to wire on a random Tuesday morning, so they are forced to sell. Forced liquidation. Not choice, forced. And when thousands of traders are forced to sell at the same time, what happens to the price? It drops, it crashes, it tanks. Not because the fundamentals changed, not because silver suddenly appeared in the vaults, not because industrial demand suddenly vanished, but because the exchange changed the rules to force liquidation. That is market manipulation, period. That is the CME and the big banks changing the rules mid-game to shake out the retail investors who dared to bet against them. And it's not the first time. Let me give you the history, because this pattern repeats. In January 2011, silver was in a major rally. It ran from about $18 per ounce to nearly $30 in a few months. Retail investors piled in, momentum built, the squeeze was on, it felt unstoppable. And what did the CME do? They raised margin requirements. Not once, not twice. 5 times in 9 days, 5 times in 9 days. They took the margin from around $6,000 per contract up to about $21,000 per contract. That's a 350% increase in a week and a half. Think about what that does to a normal person. You wake up excited, you're up on your trade, and suddenly the exchange tells you your deposit needs to triple. Most people can't meet that. So they sell. Not because they changed their mind, but because they got shoved out. What happened to the price? It dropped hard, from around $30 down to about $26 in days. Thousands of retail traders were forced out. The rally stalled. The headlines changed. People started saying, see, it was a bubble. But here's the key. The fundamentals didn't change. So silver recovered. It kept climbing. By April 2011, it was approaching $50 per ounce. And what did the CME do? They did it again. More margin hikes. Then on a Sunday night, April 24th, 2011, a day that still lives in infamy in the silver community, they delivered the knockout punch. They raised margins massively when markets were closed, when people couldn't react, when stops couldn't adjust, when fear could do the most damage. When markets opened on Monday morning, the price gapped down. It crashed from $50 to $42 in a single session. Then it kept falling, $35, $33, all the way down to $26 by the end of September. That event is known as Silver Sunday, and it wasn't caused by fundamentals. It was caused by rule changes designed to crush retail investors and protect the banks. Now fast forward to 2026. History is repeating. Silver just broke $85. Shanghai is trading 93s. The squeeze is on. The system is cracking. And what does the CME do? They raise margins. They flip the system from a fixed dollar amount to a percentage of notional value. They force liquidation. They manufacture a sell-off. Same playbook, same tactics, same goal: protect the banks, crush the retail traders. But here's the part they can't escape. It didn't work in 2011 in the long run. Yes, they slammed the price. Yes, they shook out traders. Yes, they scared people. Yes, they bought time. But they didn't solve the underlying problem. They only changed who was allowed to stay in the game. And in 2026, reality is harsher than it was in 2011. This time, the shortage is real. This time, industrial demand is off the charts. This time, China has shut off exports. This time, the Shanghai Premium is $14 and widening. This time, the physical market is disconnecting from the paper market in plain sight. And you can't manipulate physical reality. You can manipulate paper contracts. You can change margin requirements. You can force futures traders to liquidate. But you can't force a solar panel factory to stop needing silver. You can't force Tesla to stop building EVs. You can't force the Chinese military to stop manufacturing missiles. And you can't print physical silver out of thin air like you can print dollars. So the manipulation will fail. It may delay the inevitable. It may shake out weak hands. It may create volatility and fear. It may make your chart look ugly for a few days or a few weeks, but it will not change the destination. The destination is $375 per ounce, and I'm going to show you exactly why. While the CME was changing margin rules to protect their banking friends, one of the most respected macro strategists in the world dropped an analysis that explains what is coming for the global economy. His name is Tom Bradshaw. He's been in the financial industry for decades. He's not a random YouTuber. He's not a conspiracy theorist. He's a professional analyst who works with institutional clients. He went on ITM trading and presented what he calls the 38% signal. Here's how it works. Bradshaw studied every major economic cycle over the past 50 years and found a pattern he says has a 100% success rate. Whenever gold rises more than 38% in a single calendar year, a severe recession follows within 12 months, every single time. No exceptions. He says it has happened 3 times in modern history, 1973, 1980, 2008. Let me walk you through each. In 1973, gold rose over 40% from about $63,000 per ounce to around $97. The following year, 1974, the United States entered one of the worst recessions since the Great Depression. Unemployment spiked, GDP contracted, stocks crashed, inflation surged into double digits. It was a system stress test, and the system failed. In 1980, gold rose over 100% from about $512 to $850. The following year, 1981, the United States entered another brutal recession. The Federal Reserve had to raise interest rates to 20% to break inflation. Unemployment pushed toward 11%. It was ugly, and it reshaped an entire decade. In 2008, gold rose over 30%, from about $833 to $1,087. The recession was already beginning and then exploded into the financial crisis. Lehman collapsed. Stocks lost about half their value. Credit froze. It was the worst disaster since the 1930s. So the pattern is clear. Gold rising more than 38% in a year is a warning signal. It is the market screaming that something is wrong. It is capital fleeing paper assets for hard assets because confidence is cracking. And now in 2025, gold rose over 40% from around $3,000 to over $4,600. So the signal has been triggered, the alarm is ringing, and according to Bradshaw, the recession is coming. But here's where it gets more interesting. Bradshaw doesn't think we just slide into recession and stay there. He thinks the pattern follows the 2008 playbook. First, a short-term liquidity crunch, a moment when everything sells off together. Stocks, bonds, commodities, crypto, everything, because people need cash. They need liquidity to meet margin calls, pay debts, cover losses, and survive. In 2008, gold and silver sold off at first, not because they were bad, but because people were forced to sell everything to raise cash. Gold dropped from around $1,000 to $730 in weeks. Silver dropped from about $21 to $8. But then the Federal Reserve stepped in. They printed trillions. They bailed out banks. They flooded the system with liquidity. And then gold and silver exploded. Gold went from around $730 to about $1,900 over the next 3 years. Silver went from about $8 to $49. The real bull market didn't start until after the crash. The crash was the shakeout, the final liquidation of weak hands before the big move. And Bradshaw thinks we're about to see the same pattern. Short-term liquidity crunch. Everything sells off, everyone panics. Then the Fed prints, and gold and silver go vertical. And here's where it gets absolutely wild. Bradshaw has specific targets. He's projecting $9,000 per ounce for gold and $375 per ounce for silver by 2028. Read that again. $375 per ounce for silver. Not $100, not $150, $375. That's more than 4 times the current price. That's a 440% move from the $85 level, even before you factor in what physical premiums can do when supply disappears. And he says he's not guessing. He's basing it on historical cycles, monetary expansion, debt levels, and industrial demand. He's saying the math is forcing the outcome. Now let me connect the dots, because none of this is random. The CME raised margins. Why now? Why in the middle of a rally? Why right after silver breaks $85 and Shanghai prints 93? Because they know what is coming. They know the 38% signal has been triggered. They know recession risk is rising. They know that when recession hits, the Federal Reserve will be pressured to print another $5 trillion, $10 trillion, whatever it takes to stabilize the system. And they know that when the Fed prints, gold and silver go parabolic. And they know that if retail traders are still in the trade when that happens, the banks are finished. Because the banks are short silver, massively short. They've sold paper silver for years to suppress the price and profit from the suppression. They've relied on the idea that paper can always settle paper, even when metal is scarce. But if silver goes to $375, those short positions turn into catastrophic losses, the kind that can bankrupt major financial institutions. So what do? They change the rules now, before the big move. They raise margins to force retail traders to sell. They create fear. They manufacture a pullback. They shake out weak hands. So that when the real rally begins and when silver moves from 85 to 150 to 250 to 375s, the retail traders are not in the trade anymore. We got liquidated. We got scared out. We sold at the worst time. And the banks get to cover their shorts at manageable prices before the explosion. This is financial warfare, and we are the target. But here's the beautiful part. They are showing you their hand. By changing rules mid-rally, they are admitting they are scared. They are admitting they are losing control. They are admitting the fundamentals are against them. And the only way they can win is by changing the rules. When your opponent has to cheat to survive, that is not the moment to fold. That is the moment to hold. That is the moment to look them in the eye and say, I am not selling. Now let me show you the disconnect between the paper market and the physical market, because this is where the lie becomes obvious. In the paper market, the CME just raised margin requirements. Leverage is down. Forced selling is happening. The price is under pressure. Traders are panicking. Charts are flashing red. And fear is doing what fear always does. But in the physical market, nothing has changed. They know the 38% signal has been triggered. They know recession risk is rising. They know that when recession hits, the Federal Reserve will be pressured to print another $5 trillion, $10 trillion, whatever it takes to stabilize the system. And they know that when the Fed prints, gold and silver go parabolic. And they know that if retail traders are still in the trade when that happens, the banks are finished. Because the banks are short silver, massively short. They've sold paper silver for years to suppress the price and profit from the suppression. They've relied on the idea that paper can always settle paper, even when metal is scarce. But if silver goes to $375, those short positions turn into catastrophic losses, the kind that can bankrupt major financial institutions. So what do? They change the rules now, before the big move. They raise margins to force retail traders to sell. They create fear. They manufacture a pullback. They shake out weak hands. Shanghai is still trading at 93. Physical buyers are still paying up. That is a premium over the COMEX spot price. Dealers in the United States are still charging $8 to $10 premiums for physical coins and bars. Some dealers are charging $15 over spot. Mints are still reporting delays of 8 weeks or more for new orders. The physical shortage is still real. The vaults are still tight. Industrial demand is still exploding. The Chinese export licensing system that went into effect on January 1st is still in place. None of the fundamentals change. The only thing that changed is the rules of the paper casino. And here's the key insight. The CME can change margins to 100% if they want. They can make futures trading so expensive that nobody can afford it. They can choke off the paper market, but that does not create a single ounce of physical silver. It does not open a new mine in Mexico. It does not convince China to export again. It does not reduce demand from Tesla, Apple, or solar panel manufacturers. All it does is temporarily suppress the paper price while the physical shortage worsens in the background. And eventually the paper price must catch up to physical reality. because you cannot deliver paper, you cannot build a smartphone with a futures contract, you cannot make a Patriot missile with an ETF share. At some point, someone needs real metal, and when industrial buyers stand for delivery, when they demand physical bars, and the comics cannot provide them, the paper market dies. Then price goes to wherever the physical market says it should be. According to the Shanghai Premium, that reality is already above what your screen says. According to Bradshaw's analysis, that reality eventually reaches $375. So here is what the CME is trying to do. They are trying to create a sell-off today, right now, to scare you. They want you to see a red candle. They want you to see silver dip from $85 to $82.80, maybe $78. They want you to panic. They want you to think the rally is over. The bubble popped. I better sell before it goes back to $50. They want you to forget Shanghai trading at 93. They want you to forget physical premiums. They want you to forget the industrial shortage. They want you to forget the $375 target. They want you to focus on the $5 pullback and hand them your position cheap so they can cover their shorts at $80 instead of covering at $150, so they can survive what is coming. This is the last desperate move of a broken system. This is the death rattle of a rigged casino that knows the game is almost over. And if you fall for it, if you sell physical silver because the paper price dropped a few dollars, you may regret it for the rest of your life. So let me be very clear about what you should do right now, depending on where you are. If you own physical silver, coins, bars, rounds, in your safe or in allocated storage, do not sell. Don't even entertain it. The paper market is lying. The physical market is telling you the truth. And the truth is, silver is scarce. Demand is exploding, the system is breaking, and the price path is higher. If you own silver futures and you received a margin call this morning, you have a decision. If you have extra capital available, if you can deposit more money to meet the new margin requirement, you can do it and hold your position. But if you don't have that capital, if you're maxed out, then close the futures position and use the proceeds to buy physical silver. Get out of the paper market where they can change rules on you overnight. Get into the physical market where they cannot touch you. Physical silver is the lifeboat. Paper silver is the Titanic. Choose wisely. If you don't own any silver yet and you've been waiting for the right time, this is it. Do not wait for $70. Do not wait for CNBC to tell you it's safe. Do not wait for your financial advisor, who probably doesn't own an ounce of silver himself, to give you permission. Buy physical silver now, today. Pay the premium, deal with the delay, accept that you might pay $93 or $95 all in when the spot price says $85. Because in 6 months, if spot is at $150 and the dealers are sold out, you will wish you paid $95 today. This is not financial advice. I'm not your financial advisor. I'm not telling you what to do with your money. But I am telling you what I see. A paper market dying, a physical market screaming shortage, a Federal Reserve trapped, a recession signal with a perfect historical record, a macro strategist projecting $375 silver, and a futures exchange so desperate to stop the rally that they are changing the rules in the middle of the game. All the signs are pointing in the same direction. All the evidence is screaming the same message. The only question is whether you're going to listen or whether fear and manipulation will trick you into selling the best trade of your lifetime. The choice is yours, but make it fast, because the window is closing. This is John A.G. from Currency Archive. The CME just nuked the margins. The rug pull has been confirmed, but the physical shortage is real. The recession signal is real. The Shanghai Premium is real. And Tom Bradshaw's $375 price target is real. Do not let them steal your silver. Do not let them shake you out. Hold the line. The empire is striking back because they are losing. And when your enemy is desperate, that is when you press the advantage. $375 is coming. The timeline is accelerating. The fundamentals are undeniable. Remember to like, subscribe, and share. Get your money out of the paper market. Get your money into physical silver. Do it now. Go, go, go.